that's not going to be your option going forward. If you make that same decision in, say, 2025, and you say, I think the market's bottoming, I'm gonna put my money in, and let's say your money was in cash, or you're a new investor, I'm gonna put my money in an index fund and expect results like the last 20 or 30 years, you're gonna be disappointed.
Welcome to the Rose Show podcast.
I'm just saying, I think we have enough of a runway here to have that sweet spot work for us, and then you got to start worrying about the other side of the mountain.
Exactly, well said. It seems to be this lag effect. We're in we're coasting, and so we have this going on right now. But then this is part of the pre-bust. This is the end of this secular bull market that we have 41 years. And now it's going to end with a big bang, literally a parabolic melt up. And so I want to go into the bust, the end of this cycle. And to me, with the massive fiscal spending that's going on, the debt hitting 34 trillion with $1 trillion in interest expense at higher levels, and massive consumer debt as well, makes sense to me as an economist that we're going to be having a severe recession. Unemployment numbers are far worse than what they're reporting. If you go under the hood, labor participation rate is lower than it was pre-pandemic. Lots of headwinds, and the macro is very bearish when you go under the hood. So tell us about this bust, probably the end of this year, next year. Your thoughts, David?
Yeah, so I think that's a good term, under the hood, because I describe it as what makes this cycle somewhat unique is the pandemic.
Mm-hmm.
So yes, I mean, people forget, I guess it's been 4 years, but we shut down the economy in the second quarter of 2020 across the world. I mean, it never been done before. We just stopped it. And then we flooded the system with money and all kinds of fiscal stimulus to make sure we didn't just go into the abyss. And not only did we do it here in the U.S., but we did it across the globe. So it can statistically, I mean, it's still pretty phenomenal if you look back at that period and what we did. We were in uncharted territory. Nobody knew exactly what was going to happen, but it looked pretty dire, not to mention the pandemic itself. And yet we came through that with this 2020, 2021 market melt up, and also an economy that held together. And, savings went through the roof. You had the highest savings rates you'd ever seen. You had, that's what money does when you just give free money away, both through the printing press, the Fed's printing press, the central bank's printing press, and government handouts. That's what happens is you can manage a system for a while. The problem is it creates fragility because, as you say, under the surface, not everybody came through that period without being hurt badly. Not everybody, and people mismanaged free money. They thought it was here forever. So, a lot of that got kind of fribbled away. It takes time when you shovel $5 trillion into the U.S. economy or into the U.S. system, and similar amounts in terms of fiscal. It takes time for that to work through the system. It doesn't go away in a year. And that's what I think we've seen from 2020 to 2024 is that it kept the economy afloat. It's not necessarily a efficient way to keep it afloat. In fact, it's not an efficient way to do it. And there's a price to pay for it. And I think that's what the bust is. It's the payback for doing such a crazy thing. I mean, just to put it in perspective, I don't think people really understand our Federal Reserve balance sheet in October of 2008 was $875 billion. that's the largest balance sheet the Fed had ever had, going back to 1913 when it was created.
Mm-hmm.
From 2008 through the next many years, we had, if you remember, we had QE1 and QE2 and QE3. We grew the balance sheet up to something like 3.6, 3.8 trillion. So we went from 875 for, almost 100 years, and then all of a sudden, went up, fourfold from there.
Mm-hmm.
So that was already outlandish, and people were pretty critical of it, and how it was propping markets up, and the Fed was just kind of giving you the Fed put was alive and well, and but then the pandemic hit, and we went from 3.7 trillion to 9 trillion over the course of the next
Mm-hmm.
couple of years. And I mean, it just, again, people need to remember we were 875 billion, probably 15 years ago, and we're now, we're under 8 again because of QT, but we went up to 9 trillion. That's, I mean,
Mm-hmm.
and we're seeing that around the globe, somewhat similar in terms of the money that was created. It creates all kinds of dislocations and inefficiencies in the system, and ultimately it created inflation. We lived through 2022 and 3 because of that money. It ultimately, with a lag, creates inflation. Too many dollars chasing too few goods.
Mm-hmm.
And but what it also did was it drove debt levels to levels we've never even fathomed before. So and because inflation broke out, interest rates broke out, and as a result, your cost of financing, of servicing that debt, surprises on the high side. And that's what you just mentioned, the $1 trillion in servicing costs here in the
Mm-hmm.
US, just for the US debt. It's larger than our military budget.
Yes.
And so you quickly are seeing that the servicing costs of our debt are going to eat up a huge part of our budget. And that means something else has to give. And all those things, we don't know exactly how it's all going to shake out, but what we do know is that it's not sustainable. And what's also not sustainable is you drove savings rates up to 40%, and then straight back down. So in a couple of years after having such high savings, it's all been drawn down. So savings rate now is down near 1%, I think 1 or 2%. And there is savings in the system, but it's certainly much less than it was. And we're looking at, the Fed's been tightening for over a year, so you're not, the liquidity is starting to go away. It's still there.
Mm-hmm.
There's plenty of liquidity for a melt up, but it's going away. And I would estimate it could stretch out, but I'm still saying second half bust, not necessarily that it starts at the end of this year, but it could start at any time in the second half of the year and probably carries to the middle of next year. Certainly nothing that says it can't get stretched out, and it might wait till almost election time and then hit. But
Mm-hmm.
it just looks to me, you look at purchasing managers numbers. If you look at the New York State, the Empire Index yesterday, it was
Oh.
tremendously lower than
Yeah.
expectations. So I'm not saying that's representative of the entire manufacturing sector, but it is certainly a red flag saying
Mm-hmm.
this is what I expect to happen at some point. Maybe this is the leading edge of it, is that the Fed has over tightened, and at some point
Mm-hmm.
you're going to see that the lagged effect has caught up, and now you're going to find out just how much they over tightened by. When you use backward looking data and
Mhm.
particularly inflation, and wait for inflation to get to your target. Inflation's, I always say the economy's a 6 to 9 month lag from money, from
Mhm.
when the Fed does something. Inflation's like a 2 year lag. So when you're
Mhm.
waiting for inflation to get down to your levels, you're 2 years behind times.
Yes.
You're really running the risk that you've way overstayed your side, in both directions when you overease or you over tighten. And that's what I think comes later this year. What month or exactly when, who knows? But I think there's a very good chance that in 2024 we get that moment of clarity where we say, "Wow, did they go for way too far?" And what's interesting is, and I don't think a lot of the media get this, and the guys that are kind of pretend they're economists on TV or think they're economists, and
Yeah.
not talking about the true economists, but
Yeah, there's a
you know who I'm referring to,
yeah.
that they get a lot of it. They're smart people, but I'm not sure they get when they're very critical, and certainly many of the people that come on the shows, professionals that come on the shows, I'm not sure they get it either. When they start being critical of the fact that, well, the street's looking for 6 cuts, and I don't think the Fed's going to do more than three, and street's looking for it in March, and I don't think it's going to happen until sometime in the second. What they don't understand, that the market may be picking up, and I don't say they are, but maybe. And the market is not any individual. The market is in aggregate a better
Mhm.
predictor than the individual economists
Mhm.
or strategists. So I have respect for the markets. They get things wrong plenty of times, so they can forecast 8 out of the last 2 recessions or what have you. But what I think may be missed is that the market, in its aggregate wisdom, is realizing that we're not that far away from that moment of clarity where you go, wow, the economy's a lot weaker than I expected. And that's why a number like the Empire number gets your attention, because that's coming. Whether this one is an aberration, an outlier, or whether this is the big leading edge of it, I think that's coming this year. Is that we're going to find out just how much central banks, not just the Fed, all central banks have stayed their welcome on the tight side too long. And that, you know, and what I say to people is, because everybody throws around the term bust now. I was the one that used it when nobody was using it, but now you hear the term bust a lot. Bust, as I define it, again, I only define what I use, for my purpose. Others can do what they want, but bust, as I define it, is it's a recession that's gone too far. It's when you get to the edge of the cliff and you actually go over it from a financial standpoint. So as I say, 2008, we came very close when General Electric almost went under, because so much of their company was the GE finance, and they depended on commercial paper, and the commercial paper market was frozen. The fact that the government acted very quickly, that our foreign financial leaders acted very quickly and unfroze that, prevented us from seeing a bust last cycle in 2008-9. Otherwise, that would have been a bust. It wasn't a bust. It was a terrible financial crisis, biggest one in the post-World War II era to date. I think this one becomes that bust that one almost became, because we do have some unique circumstances here that I think is causing central banks to go too far, to not understand the magnitude of the risk that is being taken with the policies they're taking. I don't think they have put into their equation enough the over leverage in the system. So if you make a policy error and you don't have any leverage, no problem. You correct that policy error, you might have a recession, but you fix it quick enough. If you make that policy error when you have lots of leverage, but not the leverage we have today, you can have a 2008-9. If you make that policy error when you have leverage through the roof, so much higher than it's ever been, with derivatives at quadrillions in notional value, with global debt at 320 trillion, that policy error, which is, in my opinion, over tightening by all central banks, gets magnified a lot, and things come apart fast when they come apart. So that's, I mean, it's not something I can point a finger at in time, exactly when it happens. I can only say when I put that equation together, that's the answer I get, is that we will have a bust. And a bust is something we have not seen in this country in the post-World War II era. So if people think a bust means something like 2008, 2009 was terrible. If this is worse than that, I think people need to understand it's not going to be fun.
David, very refreshing to hear you speak about this. It's a severe recession incoming. They say it's like 1970s, 2000, 2008, all combined and worse, plus massive debt. I mean, like we have 34 trillion in debt and it's increasing significantly. The fiscal spending is going on to no end. It's unbelievable how much they're spending. Inflation is cumulative. And I think that when we compound inflation, the consumer is doing far worse. They're accumulating debt, prices are higher, and the compounded inflation, some economists are saying, closer to about 7%, even though the print is 2 to 3%. It's always in how they calculate the data. And that's why I always say go under the hood. And we're talking about leading versus lagging indicators. Manufacturing tends to be a leading indicator. Doesn't look good, but the Empire State manufacturing data that we got yesterday. Also, Fed policy mistakes. I believe that they created the ZIRP policy. All that free money was policy mistake. That was a symptom for the banking crisis that we had. And then they went and they gave us a whiplash to over tighten. And they did it so fast. I actually wrote an economic paper about how the Fed waited too long after the tapering of their asset purchases to start rising the rates. If they had started earlier, maybe they could have been more gradual. Maybe didn't have to go as high. So we have over tightening, and it's decreasing the money growth, significantly decline the money growth. And that can lead to a severe recession because the supply and demand of loans, which is how 83% of money is minted, is down significantly. So we have all these headwinds going on. And I agree with you, David. It all makes sense. And then, so my question to you now is this bust, which to me is a severe recession. The debt is unsustainable. So how long do you think this bust, this severe recession will last? Your thoughts, this ballpark. And what do you think the Fed will do during this bust? Will the Fed come to the rescue and start printing again and cause more liquidity and increase their debt even more? And what will the market do during this bust time period?
Yeah, I want to step back just a second, because in what you said, I am not of the opinion, I'm not here saying this is all the Fed's fault. The Fed, we're in a super cycle. We're coming to the end of the super. I almost think it's just how it happened, how super cycles progress. Every cycle you get more excesses, and it takes more to correct those excesses to come back out of the downturns. So there's a natural progression that we're approaching 90 years into a super cycle that started post Great Depression. And so, I don't know whether it really, you could certainly, with different Federal Reserve heads or different central bankers, have gotten a little different. But I think that what we saw is kind of what happens, all the focus on ZIRP and all that had more to do with, I think, the natural progression of everything. It wasn't, the Fed's following rates. The Fed's not creating the rate cycle. The markets determined that. We were in a period of decades of disinflation that went from, inflation in the high double digits down to near zero over the course of, the 90s, the 2000s, the 2010s. And then inflation after 30 years broke out, and so they had to go the other way, and they didn't get it perfect. They were a little slow in getting it, but they thought it was transitory, and it turned out maybe it wasn't. But I think these long cycles are somewhat inevitable. You go from very little excess, it gets wound out of a depression. You come out of that depression, it takes many, many, many decades to build back to the excesses that lead to another depression. And so I'm at, and I don't think ZERP is the real reason that we're here. I think that followed disinflation. I mean, it just followed the fact that inflation got down close to zero, so rates got down near there. And the Fed followed, didn't lead, and central banks followed and didn't lead. So that all being said, as a preface, yeah, I think the global bust as a deflationary bust is what I call a global deflationary bust, because I think there'll be a period during the bust that things will be bad enough that you'll take inflation down through zero. Won't last long. It's not a long, drawn out depression. I think the bust itself is probably contained in a 12 to 18 month time frame. So if, let's say it starts in the third quarter, it could be over by third or fourth quarter of 2025. The market will probably be over months before the actual bust is over. So that could bottom, sometime in the first half of next year. So, I'm calling for an 80% bear market. So peak to trough, if I'm anywhere close on my targets, we go from 7,000, you go down 80%, you're down to 1,400 on the S&P. So and it's going to happen over many months, and it's probably going to happen in legs. So you go down, you might drop 40 or 50% in the first leg, rally back halfway, and then drop another big chunk after that. So it'll play out over many, many months. You're not going to go to a top, let's say in the second quarter, and then be down 30 or 40% a month later. It's the top will probably build over a little bit of time, and it's not going to go straight down, is what I would say. The bust itself, the reason it's a bust and not just a recession, is the financial side of things. I think you'll have a lot of involuntary debt liquidation, a lot of big bank failures. Our regional banks here, we saw in March what can happen to the banks, how quickly it can happen. But I actually think it's probably more centered overseas. Europe's got a lot. Whatever our problems are, Europe's are bigger. So I think the European banks are in worse shape than our banks, and we got hit in 08, 09 so hard that our banks were forced to get some religion. They're much less leveraged today. So I think European banks are more vulnerable. Canadian banks are in much worse shape than they were going into 2008. Australian banks have, the real estate situation over there has been straight up for a lot of decades. So there's risks in those balance sheets. Asia, we know, has problems. China, certainly, we don't know exactly how they'll handle it. Japan is a big wild card because they've been doing, keeping rates close to zero for so long. And the only way you do that is printing money. So somewhere they're going to get that breakout in inflation, and interest rates will follow that breakout. And they've been trying to hold the line, and then, the rates are starting to pressure upward. So we're not, I think they could be a big story in the bust. I don't know that, but I think so. Particularly if their rates break out, they got a big problem on their hands. So there's lots of areas around the world where I think we can see the bust play, and it is global. I was going to say something else in terms of because it is deflation. You'll get rates. You'll get rates down. I'm probably one of the very few strategists out there, economists out there, that believes we'll see new lows on rates. As I said earlier in the interview, I think you could see a 0% 10-year, maybe a quarter or a half on a 30-year. Short rates in negative territory, maybe even negative territory for the 10-year. And that's because at some point, when everything's falling apart across the globe, you got bank failures dominoing across the globe.
Mhm.
You've got, you know, people in trouble, private, corporations in trouble, etc. There's only one fix that can come in any kind of timely fashion and fix that. There'll be fiscal things done just like we saw in 2020 that we've never seen before. But the only thing that's really timely is money. You will see money printed at a rate far faster than even 2020. So if we had, just using the U.S., if we had 5 trillion printed in, or 5 trillion expansion in the balance sheet in 2020, 21, this time I'm anticipating it'll be an expansion of say 20 trillion plus. So the balance sheet that got to 9 trillion, I think can get over 30 trillion. So I mean, these are numbers that are just beyond anything we've ever seen in this world. And every central bank will be doing proportionally something similar, trying to prop up a financial system that's in free fall. That's what the bust means. It's really the financial system going into free fall. And then, there'll be obviously fallout in terms of consumer spending and triggering, down through manufacturing, et cetera. But it's really the financial leverage that, triggers this thing. And so if you create, they'll print several $trillion. Even though today, if you ask Jay Powell, he said it many times, we are not going back to that model again. We're not going to do QE like we did in the past. He buys what you said, which is, was a big mistake. ZERP and QE, et cetera, was a big mistake. We're not doing that again. And all his fellow governors would agree. They're not going to, they do not intend to see QE used in that fashion ever again. It's easy to say until you're faced with a free falling financial system, and then you'll have to do it. And like I said, they'll print several $trillion, pause, and it'll still be free falling. Print several trillion more, pause, it's still free falling. So by the time they get done, because of the leads and lags, they'll, and I'm throwing out a number. I don't have any way to, prove it, but that's my guess, is it will take that kind of something in that magnitude to save the system. And by the time they see stabilization in the system turning around, they'll have gone far too far, and you can't take it back quickly, and it will, with a lag, maybe a couple of year lag, jumpstart an inflation cycle like we've never seen in this country. So, I lived through the early 80s and Paul Volcker and all of that. I saw, interest rates go from, 8 or 9% to 15% in a hurry. I saw inflation go from single digits to 20%. This one will be, from if I'm right that we get deflation, if I'm not right about deflation, then it'll be low single digits.
Mm-hmm.
I think by the end of the decade, we could be looking at 25% inflation rates. If you see 25% inflation, you're going to see, high teens to 20% bond rates. And you're going to see money market rates, treasury bills and short rates through 20%, maybe close to the 25. So how in the world do you service a debt load? And keep in mind, if we print 20 trillion, it's going to be, if not matched, not far behind in terms of fiscal expansion. So what's 34 trillion today could be, 50 plus trillion in debt, and rates that at 5% we had trouble financing it. What are they going to do if it's rates at 15 or 20%? So that equation does not add up. It does not. There's no way you can make that work, and it leads to trouble. Where basically I think the printing press will be gone. There, because you can't, and it'll be gone well before the 2030. I think because you can't. They'll for 2 or 3 years they'll try to make it work by expanding money saying we'll print more money to pay for the interest, to allow for to monetize the debt. We'll float more debt to pay our interest to service our debt. That quickly burns itself out, because by monetizing the debt, you're printing more money, you're pouring gasoline on an already roaring fire, and it very quickly, you can't. It has diminishing returns because the rates move up fast, and whatever you're creating in debt to pay to service the debt, the costs go up, geometrically. So I think the first couple of years out of the bust, the markets can rally, and you can have inflation looking somewhat contained. It might be like it is or was in the last year or two, but single digits still. But by 26 or 27, you got your forest fire roaring away, and it quickly runs into trouble. So what does that do to the markets? It really hurts the indexes. The indexes depend, there's a PE multiple. The reason we had, the stock market go from, and I'll use the Dow because that's what I remember back in 1982, but I can distinctly remember putting money into the market at the bottom when the Dow Jones Industrial Average was down under 800. So I'm calling for it to go to 55,000 this year. So you went from 800 to, we're 37,000 now, but 55,000, let's say, in, from 82 to, 2024. So in 41 years, you're gonna, the reason you had that move was because interest rates went from 15% and higher down to almost zero, right? So PE multiples are the inverse of interest rates. You can have the opposite of that post-bust, where interest rates go from 0 up to, say, 20. Multiples get squeezed tremendously. So that means if you're in an S&P index for the last 20 or 30 years, you're outperforming most everybody, most active managers, because you had a great run. A lot of it helped along by the PE multiple expansion. You can have the opposite effect, where you're in index funds and you're saying, every time I get a statement, the value's gone down because rates are killing you. The stock market's going down. That doesn't mean there aren't opportunities in the post-bust era, but it's in things that can keep pace with inflation or outpace inflation, and primarily that means commodities and commodity producers. So it's going to be an active managers market rather than an index market. In other words, it was the smartest thing people could do in hindsight. I certainly didn't see it way back then, but if you had said back in mid 80s, I'm putting my money in an S&P index fund and I'm just going to leave it there and not look at it, you far outperformed, most of the geniuses on Wall Street. So, that's not going to be your option going forward. If you make that same decision in, say, 2025, and you say, I think the market's bottoming, I'm gonna put my money in, and let's say your money was in cash or you're a new investor, I'm gonna put my money in an index fund and expect results like the last 20 or 30 years, you're gonna be disappointed, because for a couple of years, the S&P can come out of, say, 1400, it could triple or quadruple because rates are coming down too fast because of the money that's being created.
Mm-hmm.
So you can have a big cyclical rebound, but then, say, by 26 or 27, you're facing this massive headwind of rates roaring higher because inflation's roaring higher, and PE multiples are shrinking, and the S&P is going down. But what's not going down is gold or silver or oil. I think oil can go to $500 a barrel. I think it's going to be $30 a barrel in the bust. So if you can go from 30 to 500, and you're an oil producer, you can make a lot of money because the cost, the price of what you're selling is going through the roof. So it's going to be important to understand what the next cycle is and understand that it's not the same leadership that got you here.
Well said. Well, we're definitely going to have you back on the show when this bust occurs so we can go over all of those opportunities. And like you said, there are always opportunities. So I want to talk about this cycle. I tend to believe that this is just the unraveling. I like the deleveraging of all this massive debt, all these excesses from this whole cycle that's been going on. And to me, the ZERP just accelerated it. And then COVID was the cherry on top with all that massive printing, the 5 trillion. So now it's coming to a head and we're doing this parabolic melt up, the end of the 41-year secular bull market. So when the bust occurs, David, to you, is that the beginning of a secular bear market?
Sure. And we should probably define those terms. There are cyclical bull and bear markets, and there are secular bull and bear markets, and then there's a super cycle.
Yes.
So the cyclical bull and bear market is the market that ties in with each economic cycle. So we had the cycle from say 2003 to 2008.
Mm-hmm.
And it's a cyclical bull market that went with that. And then we had the cyclical bull market that basically was 2009 to 2020, or you could say we're still in it, whatever way you want to define that. But, because 2020 was so different. But so those are cyclical bulls and bears. You had a cyclical bear market, obviously in from the NASDAQ top in 2001 to the or 2000 to the bottom in 2003. And all stocks were in that bear market. You had a bear market in 2008-9 because of what happened in the economy and the financial system. So those are cyclical bull and bear markets. There are several cyclical and bull and bear markets within a secular bull and bear market. So a secular bull market includes several cyclical bull markets, and that means from 1982 we had a big up into 1987. Then we had a big down. Then we had another big cyclical bull market from after 87 to you had a small cyclical bear market in the early 90s, but basically until 2000 you had a major top there, and then another cyclical bear market, and then another cyclical bull market into 2008, another bear market. So you had several bull and bear markets there, but secularly you started in 1982 at a bottom, and you had higher highs and higher lows all the way up. And some people quibble because there was one period where there was a slightly lower low, I think in 2008 maybe. But basically you had higher lows, higher highs, higher lows, all the way up into what I think is a final top. And what will be the secular bear means you're going to have lower highs and lower lows. So yes, if I'll just use my targets, I could be off by a bunch, but let's say we get to 7,000 on the S&P. If that's the secular top, the next top, I don't expect the next cyclical top to get back anywhere near 7,000. So let's say, like I said, we might go all the way down to 1,400 in the year after the 7,000 top. From there, you can quadruple and you get up to 5,600. You could triple and get up to 4,200, way below 7,000. So you can have a heck of a cyclical bull market, but it'll be a lower high. Then it'll go through another cyclical bear. And it doesn't mean necessarily you're going to go below 1,400 anytime soon, but you could go to, and then the next rally up still not get, may not get back up to 5,600 because you're going to have much higher rates and inflation. So you might have another rally that takes you, let's say, again, these are these are not predictions. These are just to kind of draw a
Mhm.
picture. So
Mhm.
let's say you go to 5,600 in the run out of the bust. Then let's say you drop to you might drop to 3,000, let's say. Then the next rally, or 2,500, the next rally might take you up to 4,800 or 5,000. So you're below that 5,600. Then you drop down again, maybe lower, maybe not. And then the next high, it comes in below that. So you have lower highs coming. And then you get really hit, say in the early 2030s, because rates are through the roof. The
Mhm.
the system can't fund its debt. You can't service your debt. You go bankrupt as a government. And I'm saying this is going to happen around the globe. And sometime in the first half of the 2030s, you basically see the market collapse, and it might, probably falls far below 1,400. So that's a secular bear market. Doesn't mean you're not going to have bull markets within it, but
Mhm.
they're going to stop short of that 7,000, and probably well short of that 7,000. And so we may not get back to the highs we get to this year for decades. I mean,
Decades.
not a decade, but decades.
Wow.
And I don't know whether decades is 2 or 3 or 4. A
Mhm.
lot depends on how we come out of that 2030s debacle. So, those are big picture, and people should not be, go out too far, because a lot of that is it gets a lot foggier the longer it is.
Mhm.
But just to give you a sense that when you're in as I said, there's a super cycle that is over all of that. And I think we started this super cycle right after the Great Depression. So,
Mhm.
say 1940. And I think the next one, the end of the super cycle is top, is probably, late 20s, or, probably early 2030s. That will be the end of this super cycle. And then we go through another Great Depression, probably one that'll be bigger than the 1930s.
Interesting. Fascinating. I love studying cycles and the super cycles. I actually had someone on here talking about cycles as well, and he had predicted something with, or forecasted something with, like the early 2040s, we were going to see a change, but it was going to be a difficult time period until then. So let's just finish up with this 2025 to 2026. That's the bust. You said about 12 to 18 months. So
Yeah,
after,
I'm really saying 2024 to 2025.
okay, so let's just go with 2024, 2025. So 2026 comes. Is that going to be, we're still in a secular bear, so there are going to be opportunities, but the economy, the Fed's going to have come to the rescue. They're going to have printed. There's going to be probably a resurgence, reignition of inflation. And so the 26 to like the 20, almost 29, is that going to be the economy is just going to be coasting, a market's just going to be, opportunities in different sectors, but it's not going to be like the bust. It's not going to be a recession, but it's just going to, is it going to be opportunistic times? What do you think about that time period before the 30s?
Yeah, so I'd say, things don't move that quickly. So I think you have to give it enough room and say somewhere in the early 2030s is the end of the super cycle. It might be 29, but I'd say probably early 2030s.
Mm-hmm.
So say 20 from talking about markets, I'd say from mid 25. And again, I don't want people thinking this is precise, because it could be
No,
earlier
we
or
know.
later,
Yeah, we know.
by many months, by quarters.
Mm-hmm.
But just for guesswork, let's
Yeah.
say mid 2025 to, you know 2030.
Mm-hmm.
You're going to have an economy back on the upswing. What
Oh.
people need to understand in saying that is upswing doesn't feel good for the first year or two out of a recession, and this
Mm.
will be a bad one, boss. um, you have the market is more definite, more definable. You can have a bear market bottom, and then you can see the trend upward, and month by month by month, and understand it. It'll be sawtooth, but it'll be up. The economy's not that easy. It's you've got you reach a bottom, but as far as the consumer feels, it may not feel like a bottom's been reached for another year or more. Things are still, you don't just hit a bottom and say, okay, everything's fine now. You're still dealing with all the fallout. Statistically, it's second derivative stuff. Just statistically, the rate of change starts slowing and then starts turning upward. But so an economist can look and say we bottomed, and they do this after the fact, but the recession bottomed out in whatever month. You may not realize or feel like it was bottom, even as an investment person, even as an economist, looking at this stuff on a day-to-day basis. It may not feel like a bottom for many, many months or even a year later. So, but I think probably the bottom in things would be sometime in 2025, maybe middle of 2025. But again, that second half of the decade, it's not going to be, I think the consumer, he's going to have taken a huge hit because if the market drops 80% right there, you've not only lost whatever a good part of what you invested in the stock market for the typical investor, you've also lost a lot of, you don't know what your pension fund, payout's going to be down the road because the pension funds are in trouble. And they lost a lot. You could have, I'm guessing 30%, but it could be more, a 30% drop in home prices. So even though that probably just gives back what we just got in the last few years, it's you're going to see your home equities disappeared, or a lot of, particularly for the people that bought in the last 4 or 5 years. So the consumer is going to have, and obviously you'll have unemployment up, so there'll be certain number of people that are out of work or underemployed or what have you. So the consumer's not going to just start roaring away again. He's going to be a little cautious. And what's really going to be driving the second half, I think, is going to be an economy unlike what we've had in the last many decades. It's going to be more what we saw in the early 80s before we got hit with a double dip recession, which is expansion of the manufacturing sector. We're doing a lot of reshoring and nearshoring. And so I think a lot of it's going to be, there'll be obviously technological advancements that are maybe even unforeseen today that will lead to expansion in certain areas of technology that will be part of it. But I do think a lot of it is going to be manufacturing based or capital expenditure based. Some of the government expenditure stimulus will be geared in that direction. I think just like we're seeing with semiconductors now, there's going to be a continued effort to pull away from global manufacturing, bring it back here, steel mills, what have you, saying we just can't afford to, in the crazy world we live in today, to think we can depend on China or elsewhere when things get rough. So we need to bring some of that back. And I think there's a whole new mindset, understanding that we bought into the whole comparative economics. You're an economist, so you understand the comparative economics idea of global trade is good because you're going where it can be produced cheapest, and you can then do higher end spending, or things. And what we did in that whole process is we ignored the fact that there's national security issues, there's supply chain issues, there's a trust issue that's you don't know what it's going to be, and so all of a sudden you don't know what access you have. All those things, shipping issues, etc. all those things got kind of thrown out. We only looked at the cost of production, and so
Mhm.
we ship most of our industrial base overseas, and now we're going to have to at least shift some of that back, and that's in the process of happening now. And I think that will get speeded up, and will be incentivized by the government, I'm sure. So I think the last half of this decade, you're going to have plenty of government stimulated manufacturing, and more of that side of the economy, and less of the let's stimulate the consumer so he shops till he drops. There'll be some of that, but it'll be offsetting a consumer that's got other reasons why he just can't spend. You know,
Mhm.
so in other words, I think it's going to be a very uneven economy. It's not. It may not even. I have no idea, but it may not feel all that good. In fact, I don't think it's going to feel good, because what isn't going to be working? I don't think real estate's not going to be working, because if you've got interest rates going from, you might even see a 2% more mortgage rate in the bust. But by the end of the decade, you could be looking at a 20% plus mortgage rate. That doesn't help. There's no way real estate moves up in that.
Mhm.
It only goes down. Um, I think if energy prices go from $30 a barrel for oil to $500 a barrel for oil, and gasoline prices probably go from maybe a buck and a half during the bust, or maybe even lower, up to $20 a gallon or higher. That's not going to do anything for the consumer, right? So there's a lot of things, and if this is as fast a cycle, like I said, 4 or 5 years, 5 or 6 years for a cycle, it is going to be a shorter cycle, because inflation is going to cut it short, pretty quickly. But 4 or 5 or 6 years after we've been looking at 15-year cycle, economic cycle, recovery cycle, seems pretty short. So it certainly is possible that this thing gets stretched beyond 2030 or 31. I have no idea. But if it does get cut short and it gets to early 2030s, a lot of that is because inflation's roaring away, and it just cuts everything short. And as I said, you're going to have the Fed out of the game. You're going to have the Treasury out of the game. How is the Treasury going to sell bonds when they can't? When investors across the globe look and say, how can they service that? You know, they'll be able to sell bonds when rates are in single digits still, but when rates are in double digits, I think we're going to be shut out of the capital markets. So that's part of the problem. Is we're going to be. We saw a precursor, this shot across the bow in terms of inflation going from almost 0 to 10% in 2022-3, was a shot across the bow, and everybody thought that was awful. But that's a precursor of what's coming, I think, post bust. It'll be so much bigger, and cause so much more dislocation. So I know we've gone on an awful long time. So
Yeah,
um,
well, it seems that the end of this decade isn't much of a recovery at all after this severe recession. So, and then I agree with you, reshoring is going on, protectionism. Everyone wants to be reliant on themselves and not as much having, global trade, and they're minimizing that. So, absolutely. And that is very inflationary itself as well. So, there's a lot of headwinds going on there. Now, 2030s. Let's just briefly touch upon it. I know you've mentioned it. You've called it the end of the Ponzi scheme. Good term there. I like that. I think that's your term. But the Austrians and other economists tend to call a lot of things Ponzi schemes. But I like how you coined the 2030s, the end of the Ponzi scheme. Could you tell us, just so we can prepare properly, and this is all to help people, just give us an overview of how bad it can get in the 2030s, and how long do you think it could last?
yeah. By the way, I think the thing that separates me from the Austrian school and my view is they think that's happening now. Basically, they think this is that top And
Yeah,
then
your timelines are a little different.
basically they think the collapse happens now. The reason I don't is because of the printing press. If we have a deflationary bust, central banks have almost infinite ability to print money. So that means they can push the cycle out one more time. They can kick
Yes,
the can down the road one more time.
exactly.
That's in essence the difference between my view and theirs. Is just I think we see deflation here, or we see something close to deflation, and it gives the central banks one more chance to do it. I'm not endorsing it. I'm just saying that's likely
Yes.
what we see.
I think
So,
that, yeah, they have some time and they can still keep the party going. I think they will.
and they're not trying to keep the party going. They're trying to save the system. Is basically what they're doing. And
Mhm.
if they have the wherewithal, and they have a choice between worrying about the inflationary effects of their money, um, that comes down the road 2, 3, 4, 5 years, and the what's right in front of their face, which is a failing system, they're going to choose to save the failing system, right? I mean,
Mhm.
there's no human being. Everybody can be critical of the central bankers, but there's no human being, including the Austrians, or they'd be dead wrong, that would choose to let the system break here,
Mm-mm.
because it just brings the pain that much sooner. So,
Mhm.
because the Ponzi has been building since the 30s, 1930s.
Mm.
And like I said, I believe we're going to see, central bank balance sheets, go up by more than double, by a lot more than double. I also think that the debt that is 320 trillion across the globe today could be 500 or 600 trillion by the time this is over in the early 2030s. So most of it being during, what they do during the bust, and the couple of years after that. So you're looking at, as bad as debt is now, it could, be up 50 to 100% from here, maybe, with inflation and interest rates making it impossible. So that all it basically collapses unto itself in the 2030s. And like I said, I have no idea whether that means 2031 or 2035. I can't predict that,
Mhm.
and might be more or less than that. But when it happens,
Mhm.
basically, I call it Ponzi scheme because we've had this buildup of debt, cycle to cycle to cycle to cycle, and at the end, it's gone, you know, through the roof. So the excesses. What happens is the downturns, because of the added leverage in the system, the downturns get bigger, and so the medicine that they have to give gets bigger, and it's like, you know the sine waves or whatever. They just keep getting bigger, and so we reach a point, which I think is the early 2030s, where there's no way to do it again. The central banks will be out of business. They may still be around, but they won't be able to print money because the inflation's so high. So if the central banks can't print money, they can't monetize the debt. So that means the governments can no longer be the guy that steps in and saves things. So when, as we know, when recessions hit, normally the government comes in and spends and helps offset the private sector decline, so that it doesn't get as bad. Unemployment benefits go up, and there's all kinds of, what they used to call economic stabilizers.
Mhm.
Um, but as we've gone cycle to cycle to cycle, it takes more of that. But when you get to the end of it, the governments are out of it because nobody's there to monetize their debt. There's nobody in the private markets. I say nobody, but generally nobody, um, to buy the debt. Um, and so they have no one to sell to get more money. People say, "Oh, you're a junk bond now. I don't want you." I see the writing on the wall.
Mhm.
And I'm talking about banks that are normal buyers of bonds, or insurance companies, or hedge funds, or anybody else. So they're the buyer of last resort is usually the central bank, and the central banks won't be able to do it. So basically the governments will be out of the market, as will private. Most private companies won't be able to either. So it just collapses unto itself because there's nothing to keep it going. And as we spiraled up over 80 years, or actually 90 years, we'll spiral down probably in a matter of months or a couple of years. So you could see, just like 1929 to 1932, market dropped 90%, and obviously the economy went down. I'm sure you have grandparents that tell the story, or great grandparents that they were basically, I know in my family, my grandfather ran a general store, and he in a small town, he let people buy on credit because they had no money. But then that backs to him, and they basically were living on eggs a lot. They ate eggs morning, noon, and night sometimes. So during the Great Depression, there was a lot of people just barely getting by, and I think that's what we'll see in the 2030s is, and to a much greater magnitude.
Fascinating work you've done on this. Very well thought out. Now I have to bring up the Austrians again because Murray Rothbard, I just recently read a couple of his books. He talks about the privatization of public services and how things should be privatized. And it sounds like in the 2030s, when the central banks they can no longer print, and the Treasury will be out of business, and all of this will be out, and they can't do what they've been doing to save anything, that there has to be some type of privatization coming of these services and maybe banking and all that. Do you think that's what, maybe that's what will help us? Is there always is hope at the end, but maybe there'll be privatization and that'll help us come out of the 2030s.
Yeah, what I will say, I can't even begin. My crystal ball gets very cloudy beyond this. I can't even begin to guess what fills that vacuum, because what I'm describing is a total collapse, not just in the U.S. but basically around the world. And so my fear is it will be totalitarian. The Austrians want to believe, and this is where I really find it naive, but they want to believe in a reset. It's like everything that's collapsed, then we can start over and create the system we really want. I doubt that happens. I mean, maybe, but I couldn't even begin to see that in what I see today. I mean, because of what's going on around the world, New World Order, etc. Not that China's going to be in any great shape, not that Russia's going to be in any great shape, etc. But there's so many evil forces across the world that are trying to go to a one world government, and where individual freedoms are taken away, that I can't begin to know when everything collapses whether we go more towards free market. Ideally, that would be nice, and a cleaner system, and get away from a lot of what got us here, or whether we, unfortunately, that vacuum is filled by totalitarianism and a lot of very bad things. But so I don't even pretend to know. I just go, between now and mid 3030s, and particularly between now and the end of the decade, people need to get their house in order, because that's the best way they're going to be able to survive whatever is coming.
Love that. Thank you so much for everything. You are wonderful, wonderful person, but your insights are so valuable and much appreciated by all. So thank you so much, David. And I look forward to meeting with you again, maybe around the bust period, or maybe before the bust, and we can talk about opportunities and more of your valuable insights then. So thank you so much.
Yep. Thanks for having me, Rosanna.
Absolutely.